to another edition of the McEnulty Method, where we help young adults live better financial lives. I'm joined tonight by financial expert Frank McEnulty. Frank, how you doing?
Great, Colin. How are you?
I'm good, and I'm excited for tonight's topic. So, last time we did our first session, we talked a lot about the basics of personal finance, budgeting, looked at goal setting, and tonight we want to look more into, okay, I know what my goals are, I know what my budget's going to be. Now I need to actually go set some things up to execute on that. So tonight talk about banking, savings, emergency funds. And I think the first question, you walk into a bank, we mentioned a couple different types of accounts last time. What is the difference between a checking and a savings account?
Well, checking account is, it's named because you used to write checks, right? Everybody wrote checks. So you actually had to go through a process to give somebody money. The convenience of debit and credit cards has gotten almost too easy. It's too easy to pay money. So
Yeah.
the checking account is what you use for when you're going to use that money for your monthly living expenses. That's where that money should go in a checking account. You don't earn interest usually, and you have to be real careful though as to what fees come with a checking account because it is more work for a bank to keep track of it and all that, and they do charge money. Um, some banks are very predatory for smaller accounts. Others aren't. They may start out nice and friendly, but they get worse. Credit unions, especially for younger people starting out, I think credit unions are a good choice because you're a member of a credit union, you're not a customer, and they tend to be more user friendly for people with smaller accounts than that. That's not to say, though, that if you overdraft your checking account at the credit union, they're still gonna charge you a late fee or an overdraft fee, which is where people really get hurt. You can write a 3 cent check and you only have 2 cents in your account. They're going to ding you with a $20 fee because you wrote a check that they have to return.
Somebody had to read that.
Well,
What about
that was the theory in the old days. Yeah, somebody had to read it. They had to mail the check back and everything. None of that happens now.
no.
So it's one of the huge profit points for banks and credit unions.
Okay. Now, what about you talked a lot there about the checking account. What about savings accounts?
Well,
How's that different?
savings account, it's sort of like the savings account is the money you don't plan to use immediately.
Hmm.
You're saving it up. It's in the name. I'm saving up the money to have an emergency fund. I want to have $5,000. So I put it in my savings account. When I get to $5,000, then I go find a higher paying savings account because I have a minimum $5,000 balance. You get more interest on bigger accounts
Right.
in savings accounts. So that's what you can do there. It's good to have both.
It- Most people, typically, right, when you go in and you try to open one account, you end up with both. Now, to kind of wrap up the discussion on accounts, all the rage today, and we talked a little bit about it in the last episode. High yield savings accounts. Everybody, it seems like the number one recommendation when you open an account is to get a high yield savings account, which sounds really good on paper. Oh, and get more interest on my account. But can you talk a little bit about what's different between a high yield savings account and a traditional one, maybe
Well,
pros and
the,
cons?
the, the difference is you usually have to have the higher the yield, the more money you have to have in the account.
Right,
And the fewer transactions you can do each month in the account.
right,
So banks make money by lending your money out. And they can make more money knowing that it's going to be there for a while. So in order to get a higher rate, you're going to have to, oftentimes, 6 months CD, 12 month CD, 2 year CD, they give you higher rates to keep it there. Once again, it's another one of those things, we talked about budgeting in the last episode. You can drive yourself crazy looking for the last tenth of a percent of interest. And I know people are going to say, well, I'm crazy, but okay, you've got $5,000. Getting the last 1/10 of 1% of interest on that $5,000 is an extra $5 a year. Relax. Okay. It's not going to be the end of the world. Don't be chasing different accounts all the time to try to get a little more. Now, when you get up to where you have $100,000 you need to put in the savings, and then you start chasing the accounts because it makes a difference. Now you're talking
Now it's
about a
real
thousand.
money.
Now you're talking about $1,000 difference.
Yeah.
But yeah, you don't want the bank to get your money for free. That's really it.
And you talked a little bit about this, but talked about different types of accounts. Let's talk a little bit about banks versus credit unions. You mentioned, offhand, as a credit union, you're not a customer, you're a member. Maybe you can go a little bit more into that difference and what else makes the difference between a bank and a credit union.
Well, banks are shareholder owned. They're for-profit institutions. You are a profit point for them. Um, they're FDIC insured, just like everybody else that gets FDI insurance. Anybody can open an account at the bank. Usually lower savings rates, a lot of times higher loan rates, and never invest with a bank because their costs are going to be higher.
Is there a story behind that?
No, it's just the fact.
Yeah.
Their costs are higher. It's just the way they're set up. Now, credit unions started out as institutions to serve their members, and they still are. They've blurred a little bit. They become, in some ways, more bank-like. They offer a lot of the same services as banks. Difference is banks do commercial accounts. Most credit unions do not do commercial accounts. They only do individual accounts. They're for the members.
Mm-hmm.
They're not for profit. Now they still have to make money to stay in business, but they're not trying to make a profit to pay the shareholders a dividend.
Mm-hmm.
Actually, you're the shareholder. If you have an account in a credit union, you're the shareholder. And if they make enough money, they give you bonus interest at the end of the year. I guess they don't have FDIC insurance, but they have National Credit Union Association insurance.
Which is
same
the
thing.
same.
Up to $250,000 per account. Their boards are all volunteers. Basically, how they pay their boards is every year they go on a really nice board retreat somewhere. So they all go to Hawaii for a week and they get to take their wives and it's fully paid for.
I'm trying to get on a board. They haven't let me yet, but
and so a lot of times they have slightly higher savings rates.
no.
They have slightly lower loan rates. They're often better places to try to get a loan, especially for somebody starting out, because they're there for the members.
Yeah, and I mean, even day-to-day basis, at least my experience has always been with the credit union, something goes wrong or I need help with something, they're much more responsive and not to say banks won't eventually help you, but the credit union is, at least in my opinion, has always been there to really help, as you mentioned, help the members.
Well, banks like big customers.
Right.
Credit unions are designed for the smaller customers. I don't think a credit union would know what to do if you tried to open an account with $5 million. It's just not what they do.
There you go. All right. Well, let's say I've picked my bank or my credit union. I know about my checking and savings accounts and the difference between the two. Let's talk a little bit about the different, I don't want to call them types of accounts because they're checking savings, but when we think about emergency funds versus sinking funds, we've talked a little bit, we've thrown the word out there, oh, what if you want to save for an emergency fund? Can you talk a little bit in more detail about what an emergency fund is?
Well, it's sort of exactly what the name implies. You have an emergency and you have the money to take care of it. You read or hear stories about how the average American cannot afford a $700 emergency. They don't have enough money. They have to go into debt, which means, probably using a credit card. So an emergency fund is just that. It's money you keep for the rainy day. Something happens. And once again, it's sort of money you put away and you forget that it's there. You hope to never use it. It's sort of like insurance. You never want to use your insurance. It's just there. It lets you sleep at night. Yeah. A sinking fund, like how you're describing it, is okay, I need to save up a down payment for a house. Okay, well I'm gonna just put it in there.
Right. It's a little
And
more targeted
a
towards
little more targeted, and depending
something.
on the time, how long you plan on and how long you think it's going to take you to
Hmm.
get enough to get a house. That may not be a savings account at all. That may be an investment account. You want to take
Right.
advantage of the higher returns you can get through the market so that that money grows quicker. Whereas a emergency fund is just
Right. The key with the emergency fund is liquidity. You need to be
right,
able to access that
right,
money, and obviously, we'll get to it more when we get to the investment sections. But you don't want to be getting hit with a big tax bill whenever you're trying to get your money out for
right.
an emergency. Speaking of the emergency fund, and you mentioned, people can't have at least the recent reports can't deal with a $700 emergency. How much money should somebody keep in their emergency fund?
Well, yeah, okay. What's really going to go wrong that you're going to need money for? I mean, car is probably the biggest thing,
Mhm.
as long as you got health insurance. But I'm thinking $1,000.
Yeah.
Just
Is there any general, I think that what is the general rule, 6 months? That's if, of where you're trying to get to, as always the general rule, 6 months of living expenses.
well, that's yeah. To me, that's a super emergency fund. Yeah,
Yeah.
that's a $50,000 emergency fund if you're making
Well,
$100,000 a year.
what kind of life are you living?
That's it's yeah. If and even that
Mhm.
is they always tell these things with the worst possible case. Okay, you lose your job, you
Right.
need enough money to live for 6 months. Well, not really.
Right.
You lose your job, you're going to get unemployment.
Mhm.
You can always get a part-time job until you find another real job.
Mhm.
Um, but yeah, the basic emergency fund, let's say, is $1,000.
Okay.
The world comes to an end fund, you lose your job. I would say reasonably is a good 3 months
3 months.
of salary.
Okay.
Because like I said, you're going to get unemployment. You're going to have
You can find some part-time
you can
work in
find you
today's
can find
world.
work to do something. If you want to work, you can find work. And so you say, well, I make $150,000 a year. Well, then you should have savings anyways.
Yeah.
That's a whole nother story. If you're making $150,000 a year and you don't have any savings,
We gotta we that's a whole
yeah, we got
we gotta have some
we got a
some
serious problem there.
all right. Well, let's say, and to wrap that up, I think we would say emergency fund for the liquidity piece, but still wanting to get some interest on it, you'd put that in a savings account, right? At a credit union or bank.
Well, I I think the little emergency fund,
The
yes.
1,000. Yeah, yes, yes, not the super big one.
The bigger one, invest it.
Right.
You know,
And then obviously, as you mentioned, a sinking fund, if there's a targeted goal with a timeline in it, it's more than a year, invest it.
invest it. Right.
Yeah.
Because you can't you're not going to get very far at 3% interest a year.
Hey, I really appreciate the $3 I get.
This
But let's say I've set the account up, or I've set my accounts up, and now I'm ready to start saving. Last time we talked about paying yourself first, um, and you had mentioned actually, I think you were talking about a little more from the investment side, right? Just uh, having that money taken out right from the start, not even seeing it in the paycheck. When it comes to something like an emergency fund, there's also paying yourself first. And can you talk a little bit about what that means.
Well, it'd be the same thing. You could, like I said, most payroll services, you can have your paycheck go multiple places.
Right. We have to automate your savings,
You have
right?
have
So,
80% of your pay go to your checking account for your
hmm
monthly living expenses. You have 10% go to your, or 5% go to your little emergency fund, and you have 15% go into your investment fund
hmm
just to build up money quicker. But once again, you wanna start out saving, being fairly conservative of how much you're going to put away,
hmm
because you don't want to have to go always be changing it. Oh, I can't.
Right.
It'd be far better for you to say have 90% go into your checking account and 5%
hmm
go into the other two accounts. And then at the end of the year, you go, oh, I got $10,000 in my checking account.
Right. I could save a
I'll
little
just move it
more.
over.
Yeah. Um, and then I think more so for the when you're just starting out, right? And you're not used to budgeting. Maybe you have that first job. You're not used to making that kind of money. Um, we talked a lot about don't get so caught up in the day to day and what's every cost and what am I doing here? That can drive you crazy. But there's got to be some level of review and adjustment, and what would you recommend for somebody starting out? Like how often should they be trying to identify opportunities where, oh, maybe I'm spending too much here, maybe I need to cut back on that, maybe I'm not saving enough.
Well, it's sort of like the internet shopping theory. How you protect yourself from spending too much on the internet? It's really easy.
Get a flip phone.
No,
It's about
no,
the only
not
way
even
these
not only
days.
that. You see something on Amazon, you gotta have it.
That's right. But if you have a flip phone, you can't swipe up to buy it.
You just put it in your shopping cart
Yeah.
and you leave it. You don't buy it that day because by tomorrow or the next day, you may not need it anymore. Yeah. What was I thinking? I don't really need that. Because wait, another thing that happens, Amazon and that a lot of times is you put it in your cart and you walk away. Before long, start getting emails. Hey, we'll sell it to you cheaper
Yeah.
because they don't want you to walk away and forget about it. And so I think that's, even with, yes, it'd be great to go out to the fancy steak restaurant every day, have a really nice steak. But then it's not a fancy steak restaurant. It's Tuesday. It's yeah. If you do everything, you get everything great this every day, then it's boring. And so think about, do we really need to spend $150 a head for each of us to go out to dinner? Well, we would have just as much fun if we spent $25 a head, and then once a month
Yeah.
or once every 6 months, go to
hmm
the fancy place. Then it's something special. I, it's, I think people try to, you know, make themselves feel better. And I'm absolutely convinced that most people feel a lot better when they have money in the bank.
It's true. All right, let's wrap it up with a question from a real student, specifically about opening multiple bank accounts. So here's the question. This person's figured it out. They found that they can save money best when they hide it from themselves. So that's what we've been talking about. Now they do mention they also want to donate 10% of their income, which is admirable. And they're mentioning that right now at one of their local banks, I guess, students can open accounts with a minimum of $25 in the account, and they won't owe any fees on the account until they're 25. Now, here we go. They want to open three different accounts. So the first account will be the account that they're actively spending out of. So sounds like some kind of checking account that they're using for day-to-day expenses. Account two will be a checking account for that 10% that they want to donate. And account three would be some kind of savings or investment account where they're going to put 50 to 60% of their earnings. And their first question is Is this a bad idea or can this work?
Well, I don't think it's a bad idea. I'm impressed. They think they're going to save 50, 60% of their earnings. Maybe
Maybe they're on scholarship.
they're still living at home.
You know, that could be
You
it.
know, there's nothing wrong with living at home for a couple, 3 years and saving lots of money. It really gets you set up well. Um, yes, account one, checking account, fine, get it, perfect. Account two, where they're going to put their donation money, savings account.
Yeah.
They're going to be writing checks all the time and that way they can actually save up some money and every 6 months say sit down and go, okay, what would I like to do with this money? Not you don't you don't want to get on a monthly payment plan with anybody, and that includes charities, because you forget about them, and all of a sudden it's like, wait a minute, what am I doing here? And then yeah, account three, yeah, open a savings or investment account. I would suggest opening an investment account. I know the market right now has been crazy. It's up one day, way down the next 5 days. So you say, oh my God, I can't put it into an investment account. But
Well, as we talk about, don't
you're,
worry so much about the day to day.
yeah,
You're in it for the long haul.
we're talking to a young audience here. Um, you're in it for a long, yeah, you've got 40, 50 years before you're theoretically going to need this money. And if you do things right, you may never need it. So earn as much as you can along the way. Uh, 3 accounts is more than enough. I wouldn't get any more. You start to get crazy with
Right, you're
where
getting too in
everything
the
is.
weeds and well, Frank, this was very helpful and we'll finish it on the student's last question. Just to wrap it up, any general tips other than what we've already talked about on opening a bank account as a college student?
Just make sure you fully understand the costs associated with the account.
And for what it's worth, Google, and there's a lot of good websites out there now that you can put the bank and the type of account. They'll break it down for you. What is if it's a savings account, what are the interest
Right.
rates and what are the fees associated with it. So definitely,
And
take 5 minutes to do some
and
research.
those do change over time.
Hmm.
So yes, you do need to read those notices you get from your bank because nobody balances their checking account anymore. And so it's really easy for a bank or any financial institution to just send you a note saying, okay, well, these accounts are now going to have a $20 a month fee. Ah, it's on the bank. I don't need to read it. And then you're not going to notice $20 disappearing from your account every month because you're not going through your account. You're not reconciling. Wait, what's that $20? That's what they're counting on. It doesn't sound like much. Okay, it's $20 a month, $240 a year. Starts to add up. To the bank, though, if they're getting $240 a year from a million people, they're getting
That's
240.
real money.
They're getting 240 million real money. Yeah. So it's all about paying attention. You need to pay attention to what's happening. It's your money. Pay a little bit of attention to it.
All right, Frank. Well, appreciate your time tonight to go over banking, emergency funds, savings accounts, all this good stuff. Definitely for those listening, want to be here next time because we're going to go into another very popular topic, credit score, and particularly debt management. How do you avoid common debt traps? What are some strategies to pay off those debts? So you'll definitely want to tune in for that episode. Frank, again, appreciate you for spending the time tonight. And for those listening out there, you can check out more episodes at our YouTube channel, The McEnulty Method, and we'll see you next time.